Hi everyone, I'm really excited to talk to you about ETF today. And this is actually a presentation that I did in a meetup event yesterday in the city of London for the London Investing and Trading Group. We had about between 22 people who turned up, and a lot of them have years and years of investment experience. So it was an honor for me to present my presentation to them. Today's presentation for my YouTube edition, I'm going to make it a little bit simpler, targeting at people who would like to start investing but just don't know where to start. And I'm going to take away quite a lot of jargons. I'm going to explain some of the jargon so that you don't feel daunted by the word ETF. And in my opinion, ETF is actually one of the best way for beginners to start investing. And I'm going to show you actual concrete steps of how you can start buying ETF and how you can go about assessing which are the ETFs that are suitable for you and what are the risks and costs that you need to pay attention to. So we're going to start off with an introduction of what ETF is, and we are going to talk about the history of ETFs. We are going to talk about the various types of ETF and the dimensions of how you can assess the different ETF. And last but not least, we're going to talk about the advantages and disadvantages of ETF. In this talk, I'm also going to share some of my personal philosophy of what investment is all about. I'm not going to, actually, there's no numbers and no chart in this presentation. So those of you who are put off or scared by numbers, don't worry. This presentation is specifically catered to you. So let's start. What exactly is ETF? Again, we started with the first three letters acronyms in finance already. ETF just means exchange traded funds. I go, what the hell does it mean? What the hell are you exchanging? What the hell are you trading? And what sort of funds are we talking about? Well, this is the thing about finance. And look at the languages in finance, not so much as a way for the finance people to put you off. I always think of language as a tool, right? If let's say you're an artist and you want to draw something, you need pen, you need pastels, you need the different colors, and you also need the language to describe the various brushstroke technique and even colors. Artists are very specific about their colors. Teal and blue are two different colors, and pink and fuchsia are two different colors. And which is also why in finance you feel that you have a lot of weird terms that you don't understand, but the weird terms are there for a reason most of the time. Of course, there are some other times when the finance people like to come up with weird terms just to intimidate other people, and we're not going to let them do that today. Think about exchange traded funds, just like fruit baskets. That's it. Think about it this way. Let's say you would like to have a balanced fruit diet. In addition to your macro and your meat and your fiber from veggie and all that sort of stuff. And let's just say your opinion of a balanced fruit diet is to have 2 oranges, 2 apples, 3 bananas, 2 pears, and some grapes of 2 different colors. But if you go to a supermarket like a Sainsbury or Waitrose here in London, or you go to a Coles in Australia, they sell you a pack of 4 apples minimum, and you kind of go, but I don't want 4 apples because by next week the apples will be stale. I just want 2 plus 2 oranges plus 2 pears and so on and so forth. So what do? You buy a fruit basket. So some merchants somewhere along the line started having this idea of, hey, why not I just buy the fruits as a wholesale, and then I pack them out into a fruit basket and sell them to retail investors like you and me. And you kind of go, okay, Vivian, that's simple enough. Well, you think so, but who's to say you need to have basic fruit baskets with only oranges and apples? You can have very exotic fruit basket like this one that I found on the internet. It costs £150 just for this fruit basket. And I personally like it because, well, I do have expensive taste. And I personally like it because it has a little tropical fruits. The papayas, the mangoes, the pineapples, and it has mangosteen, which I'm very, very proud of, being born a Malaysian. They don't have durians, which is still my favorite fruit in the world. And so this is what I mean by fruit basket can get very exotic. And this is not even the most exotic one. We're going to talk more about some really weird fruit baskets to the point where you start getting a bit philosophical about what exactly constitutes a fruit basket. So all of you philosophy students out there, I hope you like this. And so this is the expensive fruit basket. But you can also have fruit basket from a specific countries. Japan is famous for that, right? It's part of the culture of gifting when you buy an expensive fruit basket to your, for your bosses or your mother-in-law or somebody that you're visiting. And this is denominated in Japanese yen, so 116,000 yen would be approximately, I think, 80 pounds. Yeah, 80 pounds in today's exchange rate thereabouts. So yeah, 80 pounds for a basket of fruit with one passion fruit, two kiwis, one big grapefruit, one or two oranges, one mango, one avocado, and a peach. 80 pounds. But there's a reason why I picked Japan specifically, because you could buy a Japanese fruit basket in the financial world. And you can get really weird. You can go, well, I only want red fruits because I only like them. And yes, you can buy a red fruit basket. And then it can get weird from this point onward. You could condense the fruit basket into a fruit concentrate, not just a fruit juice, but a fruit concentrate in the form of 40 glasses of juice in one bottle. I honestly do not know how much real fruits there are in this fruit juice, but you could buy this in the form of what we call a leverage ETF, meaning allegedly for every one glass of fruit juice that you drink is equivalent to, like, I don't know, 20 fruits that you can eat. At some point you need to start asking how true that is, how nutritious that is. But this is just so that you are aware that there are products like that out there in the market. And then it can get even weirder from here. You can have fruit juice with no fruits in it, right? These are what we call the synthetic fruit juice. And you can have synthetic ETF as well. Because remember what we said, ETF is fruit basket. That's the origin of ETF. You want to buy a basket with fruits in it. But when money is involved, people start to get creative. At what point do you need to have real fruits in there? Like, that's pretty smart, right? I don't recommend synthetic ETF for beginner investors, but this is just so you know there are products out there in the market so that you are aware of the risk involved. Over here, I have to caveat, this whole video is for educational purposes only, not meant to be an investment advice, and certainly not an advice for you to buy and sell anything. And also, we are actually going to talk a lot about artwork. The old Dutch master that I talked about just now, that I use it as a front page, it was a painting sold by Sotheby's in 2022 for approximately 300,000 pounds or euro. I can't remember what's the currency. And there's a reason why I pick an old Dutch master painting of a bowl of fruits with some birds in it. Well, because we are talking about fruit baskets today. And there is a specific reason why I pick an old Dutch master painting from that era. And you will find that out very soon. So to truly understand ETF and how it will evolve from here, it pays to understand how the predecessor of ETF evolved. And the predecessor of ETF, if we really were to trace back in history, is mutual funds that were started in 1772. For those of you who watched my YouTube video quite far back, you would know that the first share market in the world was developed in Amsterdam in 1602. And people could buy and sell company, right? They buy and sell shares of a company, a fraction of the company. Somewhere along the line, this guy called Abraham van Katwijk, the Dutch people, please correct my pronunciation, he figured out that, well, sometimes it's still quite expensive for individual investor to buy a share of the big company. And that is still true for some shares today, right? Berkshire Hathaway, for example, I think right now Berkshire Hathaway, each share is about 200,000-300,000 US dollars. So I don't want to buy like one share because that basically takes away all my, like large chunk of my liquid assets. So, I might want to buy a fruit basket that has a piece of Berkshire Hathaway. So this guy, Abraham, he basically thought, hey, if I pull together money from the various retail investor, put it into one pile of money, and then with that pile of money, we can then buy X number of Dutch East India Company, X number of, I don't know, some spices company, or X number of some fabric manufacturer or something. And I pull that together. And when they either increase in price or distribute dividend, I can then distribute this money to the pool of investors who have given me money. And that's how mutual funds started. It took us approximately 180 years in actually 1930s for two researchers who did some analysis in the past and realized that, you know what, mutual fund managers who actively manage, meaning actively select what are the shares that are good quality, they don't actually do better than investors who just go, you know what, I'm too lazy to analyze the market. I'm just going to buy whatever that's the top 5 or the top 10 in the share market and let my money sit there. And in the financial world, this is what we mean by active versus passive investing. Active meaning you do an active work to analyze, is Apple better than Amazon as a share, as an investment? Is the tech market better than the pharmaceutical market in investing? So you're making active decision. Whereas passive investing is just go, I don't really care. These are the top 10 or top 500 shares in the S&P, the Standard and Poor 500. I'm just going to buy a percentage of all of them and call it a day, right? And move on with life. And the second group of investors, surprisingly, actually did better. And even till today, they still do better than most of the time than people who actively pick shares. So in 1960s, these two students at University of Chicago came up with the idea of, hey, if active management don't outperform passive management, why not somebody just come up with a product where they collect money from the individual investors and just buy the top 500 companies in the American Stock Exchange? And so it's pretty much a research paper, like they didn't execute it, but because in 1975, this guy called John Bogle of Vanguard, who started it, who make it into an actual product for people to buy. A lot of people erroneously attribute the invention of index fund to John Bogle. He didn't really invent it, but he just make it into a product that retail investors could buy. For those of you who are more well versed in the financial market, you would realize that Eugene Fama also came up with the theory of efficient market hypothesis around the 70s. And so this really coincides, right? Because if you believe in efficient market hypothesis, then, well, just buy index fund. There's no point trying to actively beat the market. So you can see this evolution from mutual funds. And by nature of mutual fund, it means it's not very liquid, meaning you can't just price it every single minute, right? Mutual funds, you can only price it when somebody wants to sell and somebody else wants to buy, and then you negotiate a price from there. Of course, you can always understand the fundamental values of the mutual fund, because mutual fund is kind of like a fruit basket as well. You could price and you say, well, each orange is X pence and each apple is X pence, and so the fruit basket should be priced at, I don't know, £2, for example. But what if somebody decided, no, it's not worth £2, it's only worth £1.80? Then you have to start to have a price negotiation. Index fund, again, the way of index fund operates, at least nowadays anyway, is priced once per day. At the end of the day, when the market has closed, and same for mutual funds, they're priced once per day. And you can't really buy them in the stock exchange. Just the nature of it is not sold in a stock exchange. You can still buy them, maybe directly from people like Vanguard, but it's just the way you buy it is a little bit different. Whereas with ETF, you can just buy in the stock market whenever the stock market is open. And in some cases, some stock markets are open 24 hours, 5 days a week. So you could really buy and sell it anytime you would like. So just understanding this, and I would like you to use this understanding of the history of exchange traded fund to start thinking about how you can benefit from it, and even predict the next step for ETF, which can get pretty fun. The types of ETF, and because ETF was launched in 1993, and when there's money involved, people get very creative, and there are a lot of different types of ETF, and ETF is constantly evolving. There are always new ETF that come out in the market. So instead of telling you the different types of ETF, I will give you a framework of understanding the different types of ETF. And with that framework, you can start assessing how risky or worth buying a certain ETF is. And this framework is basically 4 dimensions. The first one is passive versus active, which I explained earlier. The second one is distribution versus accumulation. Those of you who are very used to investing in QQQ, you don't get a lot of dividend, just the nature of QQQ. But if you are somebody who invests in, let's say, the British stock market on LSE, you get the ETF of the FTSE 100 shares. The shares on the London Stock Exchange, they tend to distribute a lot of dividends. It's just the nature of it, right? Because you have a lot of pharmaceutical, petroleum, banks, and they tend to distribute dividends. So it's a question of when the ETF companies receive the dividend, do they pay it to you or do they reinvest it back to buy more shares of those companies that you already hold? And so distribution and accumulation is almost like a one or the other. It's not a dimension, whereas passive versus active it still can be a dimension to a various degree. So distribution and accumulation, this is another thing that you need to pay attention to. And I would say if you are like earlier in your career, when you're quite young, I would recommend you to buy the one where you accumulate the shares. That way you snowball your money. Whereas if you're closer to retirement where you might need a cash flow, then distribution might be more suitable for you. Again, please do your own research. This is just my personal opinion for education purpose. With underlying asset, without underlying asset. So we illustrated a little bit more about this just now, right? Underlying assets meaning the fruit basket actually have fruits in it. You can see that it has fruits. And then you can get really weird where the fruit basket has synthetic fruits, which is not real fruits. So that's where it doesn't have any underlying assets. You can't call that fruit baskets with fruit. You might still be able to call it fruit basket, but it starts to get really weird. And then the last thing is leverage versus unleveraged. So this is almost like you're squeezing the fruit juice, right? When you condense the fruits, that's leverage. But if it's fruits in its natural form, then it's unleveraged. And for those of you who are a bit more sophisticated, you can buy so many leverage ETF out there. It's bonkers. Like you can buy obviously the most common one probably like a gold 3x ETF. I have seen like single stock 3x ETF where the volatility is insane. Good for trading, but not recommended for beginner investor. The types of ETF, I'm going to continue on this. And it's really always fun when even before I show anything, I tell you the disclaimer, not a buy and sell recommendation, not an investment advice. Please do your own research. The most basic one is your index ETF. Index just means this is the most basic plain vanilla form of ETF where you just buy the top 10, top 100, top 500 shares of a particular stock exchange. And the most popular one is SPY, which we mentioned about just now. You could also buy the UK for those UK audience, and this is one that I found with a pretty good expense ratio. It's an accumulation ETF, meaning any dividends that you get gets reinvented into the fruit basket itself. And you can also buy the Japanese ETF. I personally think Japan economy might do well in the future. It hasn't been doing well in the last 20, maybe even 30 years. And they have some amazing companies that are undervalued. Like I personally hold a share in the Japan share market. So not a large part of my percentage, not a large part of my portfolio, maybe like 7% of my portfolio. And it's one single stock, not an ETF. But I think, it's worthwhile to consider Japanese ETF. And of course, you can buy the Indian ETF, the Hong Kong ETF, and the Singapore Stock Exchange, so on and so forth. So it's really up to you. And then there is the thematic ETF. Thematic is just like what I mean by red fruits. And what are some of the red fruits, thematic ETF out there? You could buy ETF in aerospace and defense industry, with tech companies, with AI, with pharmaceutical. You can even buy uranium ETF, which I'll cover a little bit later. So you can buy like green energy ETF. So that's thematic, right? And then you have the commodity ETF. So I mentioned a little bit about uranium ETF. But commodity ETF, you can buy a very broad-based one, just like broad-based commodity. So this is very actively managed because the fund manager will then have to decide, what are the shares that I would like to buy. And then there are sector-specific ETF. So for example, you might want to buy ETF in the uranium industry. So they would hold some uranium mines as well as some uranium underlying assets. Or you could buy mining companies, just ETF for all the gold miners if you believe in gold mining, or you can buy a single commodity ETF, which I personally own. I personally own gold and silver commodity ETF. These are single, like when I buy a share of the ETF, I have legal rights to claim part of the gold or part of the silver that this company owns. Just be careful when you buy a single commodity ETF, because a lot of the precious metal ETF out there actually don't have any underlying assets supporting the ETF itself. So do be careful. And so that's yeah, single commodity ETF. And then there is a lot of weird ETFs out there. Cryptocurrency, currency ETF, bond ETF, silver. This is what I mentioned about just now. Single stock 3X, one of the nuclear power companies that I was looking at, they have a single stock 3X ETF. I thought, well, good for a bit of gambling, but yeah, scary stuff. Not recommended for long-term investing. You even have inverse and short ETF. You might have heard of the term shorting. Shorting just means you're selling something when you don't own it. And I can do a longer video explaining what shorting is. But basically, if you, let's say you anticipate the market to go down, instead of not holding the shares, which, if you are so certain of your investment, you can even short, because you are selling it at a higher price. And then when you short it, let's say you want to buy it 3 months later, if you predict that the share price will drop, you can buy it back at a lower price and repay the person who lent you the shares. It can get really weird. And then the last one that I heard just a few days ago, there's a defined outcome ETF, where they hedge against, it's kind of a little bit like a short invest ETF, but it guarantees income if the share market goes down by between 5 to 10%. I don't know how to buy it. Maybe you know, and you can leave a comment below. Actually, on that point, if you like this video thus far, please click a like and a subscribe. And most importantly, share this with your friends who would like to start learning. And most importantly, share this with your friends who would like to start investing and build wealth for themselves. And you know what they say about you being the average of your 5 closest friends? Yeah, so if your friends all get rich, you get rich too. So let's all do this together. And at this point, I want to get a little bit philosophical. So this would probably appeal to people who have like an art history background or arts background, or just even philosophy background. So this is actually one of my favorite artwork. Yeah, I sold furniture for a few years, so I geek out on furniture. But this is not about the chair, right? I like this because just generally I love conceptual art, and this is actually quite an old artwork. By this guy called Joseph Kossuth, who came up with this idea in 1965, which is actually a long time ago. So you think about this idea of a chair, and this is very relevant to the financial market. A chair is a solid product, it's a useful product, and in economics we say a chair has utility because you can sit on it. And then at some point, somebody decided to take a picture of the chair and put it on the wall. So in finance, you can call that the picture is a derivative of the chair. It's a representative of the chair. So, and then you go the next step, you can have a description of the chair. You just write it, a description, and then you paste it on the wall. And again, the description of the chair is the derivative of the picture of the chair, which is a derivative of the actual chair. So at what point does it stop being a chair? And you can think about the financial market the same. The actual underlying asset is the share of the company, right? So then you have to ask, the company, what does it do? Does it actually own any assets? Because at one point in history, we have a lot of SPAC companies where it's basically just blank check and they don't do anything. And so it can get very esoteric. And I think for me personally, I joke that I'm a very much brick and mortar sort of person. I like things with underlying utility. I like things with underlying values, and I like the physical chair. And I digress a little, but I personally am passionate about this piece of artwork, and I hope you learn a little bit about how I think about the financial market. And if you didn't learn anything new about the financial market, I hope at least you learned a little bit more about art history. And so let's think about how you can buy ETF, because ultimately we want to benefit, we want to invest, and we want to make money. You buy ETF in the UK through investment platforms like Trading 212, eToro, Robinhood, II, and IG. I personally have used II and IG. And I think if you are, let's say, a beginner investor, maybe Trading 212 and Robinhood and II might be probably suitable for you. I have been investing for more than 20 years, and I personally love IG because I love the charts and the platform and the information that they can feed me. So the first thing you need to do is to open an account with some of these guys. I think there are a lot of brokers, so we call them brokers. There are a lot of brokers out there in the market. Just be careful. I've heard some really weird stuff about some brokers from outside of UK. If you would like, we could actually go to FCA, the Financial Conduct Authority. They have a list of approved brokers here in the UK. I can put the link below just to make your life easier. And if the broker doesn't appear on the FCA list, chances are they're just really dodgy, and I would not recommend you to use them. But if they are on the FCA list, and all those people that I mentioned, they are on the FCA list, then they're good to go. So you open an investment platform. On that note, there are also ways to make your investment more efficient, and that's in the form of tax wrapper. So in the UK, the tax here is really complicated. I'm going to do another video about that. A lot of people have heard of ISA, individual savings account, and there are, I think, 4 different types of ISA, where you have the cash ISA, the stocks and shares ISA, and then you have the LISA, which is a lifetime ISA, and I can't remember the last one. And there are like junior ISAs and so many, too many. What you need to do if you would like to start buying ETF is to open a stocks and shares ISA with any of the 4 guys that I just mentioned. And ISA basically just means any gain that you made. It could be dividend, it could be capital gain. Let's say you bought something for £10 and then you sold for £15. You make £5 out of this transaction. If the shares are not parked under an ISA or SIP or company wrapper, you are liable to pay capital gain tax for that £5 of gain that you make in your shares. So I always recommend people, the first thing you need to do, open an ISA account. ISA account, you can treat it like a bank account. You can take the money out anytime. You can pump in £20,000 every single year, and the financial year ends on the 5th of April, which is not that far away. We're only 2 more weeks to go. And so I would highly recommend people to open an ISA account with any of these traders. I personally have a referral link for IG. So if you would like, I will put the link below. You can open an account with IG, and I do get a referral fees if you end up opening an account with IG or ISA or even a SIP account. SIP is not widely understood, especially for people who are new to the UK. And I think I need to do a separate video about SIP. Very tax efficient way of investing. Company pension, I mentioned a little bit about it in one of my previous videos, but I think I probably should do a video just on company pension and SIP. So efficient tax wrapper. And just be careful of who you're buying the ETF from, right? You're buying a fruit basket. How can you be sure that the vendor who's selling you the fruit basket is selling you the freshest possible fruit that is not rotten? Because you could be sold a fruit basket with rotten fruits in it, right? And some of the names that are trustworthy, so anything that is sold by Vanguard, iShares, Invesco, usually they're quite trustworthy. You probably can't buy like ETF directly from Vanguard, and even if you can, it might not be tax efficient, for example. But what you could do is you could open an ISA account with, let's say, Trading 212, and through Trading 212, you buy an ETF that is managed by Vanguard. That's how it works. That's a relationship of these different players in the market. One thing you really need to pay attention to in buying ETF is what we call the expense ratio. Because you're not going to get the fruit basket for free, right? Even the basket itself costs money. The person needs to be paid. The person who put together the fruits needs to be paid. And this is what we call expense ratio. it is quite a competitive market out there selling ETFs, and most ETFs have an expense ratio of 0.07 to 0.3. So very, very efficient. You don't pay this 0.07%. This money pretty much come out from, let's say, end of the year. The fund manager, the ETF manager, will take 0.07%, maybe liquidate that in the market, and pay and distribute that as a salary, administrative costs and so on and so forth. So in that sense, there's no money kind of coming out of your own account, but your share portion reduced by 0.07% after you get your dividend and capital gain and all that sort of stuff. There are some really weird ETF out there, like we mentioned. So the weirder the ETF, the more expensive the expense ratio is. And I have seen some ETF with 15% expense ratio. I'm like, who buys them? They better be really good product. And I personally was like, I don't understand it enough, so I'm not gonna buy them. And so yeah, pay attention to expense ratio, pay attention to who's selling you the ETF. And fine, how do you make money? How do you make money from ETF? I would say for a beginner investor, if you never invested before, just buy what they call the plain vanilla ETF. The SPY, which is the American S&P 500, QQQ, I mentioned a little bit about it just now. The FTSE 100, I also mentioned it a little bit just now in my presentation. And if you're a little bit more intermediate, you can start thinking about country or industry specific ETF. Sometimes I get people asking me for investment advice. And my philosophy is that investment is very, very individualized. You need to understand your own personality, your strengths and weaknesses. And investing and how to beat the market is really about playing to your strength. I'm ethnic Chinese. I was born in Malaysia. I wasn't born in China. And I'm a Singaporean now, and I speak fluent Chinese. So I have an advantage in understanding the Hong Kong and the Chinese share market better than most people. And I also have a keen, well, I live in the UK, and I live in the UK for the past 7 years, and I would have a better understanding of the UK share market than somebody who's based in, let's say, Japan, who have nothing to do with the UK. So you always play that to your advantage. I have friends who are in the medical field. They would understand the pharmaceutical company much better than I do, and the learning curve for them is a lot lower. So find out your specific skill set and play that to your advantage. Expert level people, you could use levered ETF, inverse ETF, defined outcome ETF, the weird stuff out there that I don't understand, so I can't provide you with any advice. And on that note, I sort of briefly mentioned this. Sometimes when people ask me about investment advice, and when I look at a lot of content creators out there who's very rah-rah about how you invest, and they can be very, how can I put this, dictatorial about this, authoritarian about this. That's not the style I like. And over here, I'm going to share a story with you. It's actually a really old story. It's a Buddhist story from approximately 2,000 years ago about four blind men and an elephant. One day, an elephant happened to wander around to a village full of blind men and women. Well, this being an older story, the characters are all men, but let's be politically correct here. And and the villagers start to get really curious, and they started touching the elephant. But remember, they're all blind. And so one guy went to the elephant trunk, the front of the elephant, and started touching the elephant trunk. It's like, oh wow, it's like a snake. It's long. It's long and like flappy. It's like a snake. Yeah, elephant is just like a snake. And then the second blind man happened to touch the torso of the elephant. It's like, oh, you're such an idiot. Elephant is like a brick wall. The skin is rough. It's kind of flat. It's just like a brick wall. I don't know what you're talking about. You're such an idiot. And the third man was holding on to the elephant ear. And they go, oh, I can't believe how big of an idiot two of you are. The elephant is really a flimsy, flat of thing, kind of like a gigantic bat wings. Yeah, that's what elephant is. And the fourth man happened to hold on to the tail of the elephant. It's like, you guys are such an idiot. Seriously. Elephants are just like a plant, like a rattan. You can swing it around. It's like furry towards the end and it's kind of flimsy. So, yeah, you guys are idiots. The thing is, the financial industry is so complex that no one person have full understanding of what it is all about. And the thing is, it's a constantly changing animal because even if you are an expert and you have touched all the surfaces of an elephant, you still don't understand how the skeleton of the elephant works. You don't understand how the heart of the elephant beat and how the stomach of the elephant function. You need X-ray vision to do that, which of course you could acquire the skills, but what I'm saying is everybody have a slightly different point of view of the elephant, and we are all correct and incorrect at the same time, which is why I really advocate people to understand the strength they have, the unique strength that they have, and play that to your advantage. And also, if you listen to somebody whose view is different from you, give it some benefit of doubt. Just because their view is different doesn't mean that they are wrong. And um, do what you can with this piece of information. Advantages of ETF. Low fractional amount. You can start investing in ETF with £100, £200, right? It makes it a lot easier for you to consistently invest every single month. And built-in diversification, right? By nature of the ETF, most of the ETF anyway, unless you buy some crazy single stock ETF, 3x leverage, most index and thematic ETF will have built-in diversification to it, which reduces your risk. And last but not least, it saves time. Over here, I have annual report of NVIDIA in 2025, as it's just one 2025, one single annual report, and the whole report was like 300 pages long. And like if you just want to buy the Mac 7, are you going to read the annual report for all 7 companies for the past 3 years? Right? So it's much easier to just buy an ETF and you don't have to bother yourself with reading the financial report. But that said, there are disadvantages of ETFs as well. I have a confession. I only own 2 ETFs. And these are single commodity ETF, gold and silver, because it's a lot easier to buy a gold and silver ETF than to buy physical gold and silver. The reason why I'm a make from scratch person is because when I first started investing, there was no ETF in the Malaysian share market. Like I have to buy single stock, and I'm dating myself. I started investing more than 20 years ago, and the thing about the beauty of buying individual shares is because I had such a huge learning curve when I first started investing. The learning that I did in the initial part of my investing helped me become a better investor. So I'm quite lucky that in the last few years, I managed to beat the market as opposed to beat the market, meaning I outperform in a normal ETF. And if I haven't put in the effort to learn how to invest in individual share market, I wouldn't have outperformed the market. And in fact, the first 15 years of my investing journey, I probably would have been much better off just investing in ETF. And it's the same for somebody who buy a ready-made meal in Waitrose or M&S or Sainsbury, because it's very convenient, right? You don't have to think too much about it. But if you over rely on ready-made meal too much, you don't know how to cook things from scratch anymore. And it could be an advantage or disadvantage. It really depends on what you want to do with your life. Some people take a lot of pride in being able to cook a meal from scratch. If you're not that sort of person, then that's fine. Buy an ETF. The other second, the second advantages of ETF is something that I want you to pay attention to. It's not a problem right now, but it might be a problem in the future. I don't know how many of you have heard of the banana disease. So, do you know that in the Western developed world, all the bananas that you eat is from one single species? For those of you who understand biology, you know that banana is not just one single species. There are multiple species of banana. And the one single species we eat in the Western world is called the Cavendish. The problem with the Cavendish is it's susceptible to a fungus virus that once it's infected, it could wipe out like the whole farm of bananas. It's very difficult to eradicate them. And at some point, actually, in the last few years, the world was at risk of having all the bananas wiped out by that one single fungus because we were so reliant on one single species of bananas. And in the finance world, we call this the concentration risk. And concentration risk would mean things such as if too many people buy the S&P 500, and if the direction of the world economy changed suddenly. Let's just say this is like an out there example, and by no means I'm saying this example will become true. In fact, the probability is quite small. Let's just say nobody knows how to invest in pharmaceutical companies anymore. Everybody wants to put money in S&P 500, which is very tech heavy, and suddenly we are all hit by another virus, right? And we realize that actually we are very reliant on pharmaceutical company, but people don't know how to pivot because you have way too much of your money invested in the S&P 500, and and it leads to a market structure where winner takes all. It leads to a market structure where the big gets bigger with no justification. There's no, it dealings from the fundamentals of, is Apple or Nvidia really worth that much? Right. So the concentration risk could potentially lead to underperformance, because when everybody buys something, that something becomes so overvalued that it has no real underlying value supporting the price that people are paying. Getting a little bit esoteric, but if you're a beginner investor, you can probably just ignore what I just said. And if you're a beginner investor, the decision that you might need to make is really just country specific ETF, right? If you're watching this from the UK, I would actually advocate you to start investing a bit of your money into UK ETF, because I personally think UK ETF might do well in the future. Just my personal opinion. And so if you're not watching this from if you're watching this from outside of the UK, and there is a specific country that you're very familiar with, for example, India or Japan or Malaysia or Singapore, and you are positive about the economy development in that country, then maybe it's worthwhile for you to buy ETF in that specific country where you have a really good understanding, right? So that concludes my presentation, and thank you so much for your patience, and this has been fun. If you find this video useful, please click a like and a subscribe, and most importantly, share this with your friends. Okay, bye.